Okay, let me ask you this. Why are US oil companies adding rigs right now, in 2026, when the entire world seems to be talking about moving away from fossil fuels? That's the bizarre contradiction in this week's Baker Hughes data. On the surface, it looks routine, rig counts up slightly, Permian Basin hits 263 active rigs. But dig deeper, and this report reveals a high-stakes game of chess between energy demand, investor pressure, and geopolitical chaos. Let's unpack this. First, the numbers: 454 active oil rigs, up 3 from last week. That sounds aggressive until you realize how tiny this increase is relative to the total. Companies aren't flooding the market, they are dipping a toe in. Why? Because Wall Street is watching. Investors who forced big oil to prioritize profits over growth since 2020 aren't going to tolerate another spending spree. So this 0.6% uptick? It's not a boom, it's a cautious experiment. What many people don't realize is that shale producers have spent the last 5 years rewriting their business model. They are chasing break-even budgets, not market share. That's why production only inched up to 13.8 million BPD despite more rigs. Efficiency matters more than ever. Now look at the Permian Basin's 263 rigs. This isn't just America's oil heartland, it's a tech laboratory. Companies here aren't drilling randomly, they are testing longer laterals, AI-driven seismic imaging, and electrified rigs powered by solar. That's why Permian's output keeps climbing even as other basins stagnate. Eagle Ford's plateau at 49 rigs. That's telling. Without the Permian's infrastructure advantages, smaller plays can't compete. This divide highlights a broader industry truth: in the energy transition era, only the most adaptable oil fields survive. But wait, oil prices dropped $6 a barrel this week despite these gains. That's the market's way of saying, nice try, but we're not convinced. From my perspective, this price volatility exposes the fundamental tension in today's oil market. Producers keep trying to balance OPEC+ supply cuts with US shale's flexibility, but global demand is a wild card. China's stimulus efforts, Europe's recession risks, EV adoption rates. All these factors create whiplash. And let's not ignore the elephant in the room: at $78 for WTI, we're still in a bull market by historical standards. Companies are making fat margins without needing to flood the market. Here's the part that fascinates me: frac crews dropped by 4 while rigs increased. That's like ordering more pizza ovens but laying off delivery drivers. What gives? My take? This is the physical manifestation of the capital discipline era. Operators are drilling wells faster than they are completing them, basically stockpiling drilled but uncompleted wells as strategic inventory. It's a hedge against future price spikes without committing to full production. Meanwhile, gas rigs falling again shows where priorities lie. Despite Biden's hydrogen hub investments and EV mandates, oil remains the cash cow companies need to fund their energy transition bets. Let's zoom out. This report isn't just about machinery counts, it's a window into big oil's identity crisis. Companies are caught between shareholder demands for dividends, ESG reporting requirements, and the reality that global oil consumption still hits new records every 3 years. The Permian's resilience proves that American shale can't be killed, but the cautious rig additions show producers have learned from the 2014 to 2020 boom and bust cycle. They are not chasing growth, they are building flexibility. So here's my closing thought: what happens when the world actually does need less oil, say, if battery tech has a breakthrough or global recessions crush demand? These Permian rigs represent billions in sunk costs. Will they become stranded assets, or will they pivot to carbon capture wells and geothermal projects? The industry's future might depend on how well these drillers can rewire their operations for a lower carbon world, while still paying dividends today. What do you think? Can big oil pull off this balancing act, or are we watching the last gasp of the shale era? Let me know in the comments.